Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I'm going to do a quick video today on keeping your composure when you sell puts and then the stock goes down. You buy the shares and then you maintain a short-term unrealized loss. So someone asked me yesterday how you kind of maintain your composure, how you overcome that feeling of uncomfortableness when you have a sustained short-term unrealized loss from the stock price going down. Stay tuned. So first of all, as I said before, I really focus on realized gains, making realized gains, and avoiding realized losses. Now, what are realized losses? I mean, a realized loss is when you sell something for less than what you paid for it. An unrealized loss is just that paper loss, having or holding shares of stock and the value of that stock going down, right? Now, I think it was Warren Buffett who has said, if something is, great, a stock is great at $100 per share, it's great at $90 per share, it's great at $80 per share. So a great way to combat the declining price of a stock is to buy more shares as the price goes down. Now, if you don't have to access the money in your account or a chunk of money in your account, it's okay. It's kind of like owning a house and then, having a housing crisis like we had, let's see, back in 2007, 2008. For example, let's say I own a house and my house value is $500,000, and then there's a housing crisis and now my house is worth $300,000. It doesn't really matter if I'm not selling my house, right? So this is the same thing. In fact, what I like to do, if and when the prices come down, first of all, let me back up a moment. I do want to specifically say something that's important, and I know I've said this before. When you sell a put on a stock, you have to be okay with buying, or you should be okay buying that stock at that particular strike price, right? Now, that said, you're not ever stuck in stone to do that. You could always buy your contract back. You can change your mind. But for the most part, when you sell a put with a strike price of X dollars, you're kind of saying, you're okay to buy that stock at X dollars. So if the price comes down, and it comes down and down and down, it's only affording us an opportunity to buy more shares of that good stock at a cheaper price. It's a good thing. It's not a bad thing. So it's kind of all about rewiring your brain and not caring so much about an unrealized loss. An unrealized loss is not relevant unless you're having to access a chunk of your account, right? It's not relevant. Just care about realized gains. Realized gains are what I use to sustain my lifestyle. That's what I focus on, realized gains. So now that said, as things come down, I'm going to give you an example. Right now I have some Tesla shares, right? So I have some Tesla. I'm going to use round numbers just to illustrate the mathematics of it easier, right? So I have 100 shares of Tesla at $350. Then I bought 100 shares of Tesla at $325 because it has come down, right? Now, today, it came down a lot more. I bought 100 shares more. And let's say now I have 100 shares at 300. So 350, 325, 300. I'm averaging my price down. Now, if you average all those numbers, 100 at 350, 100 at 325, 100 at 300, that means I own 300 shares at an average price of 325. I could do one of a couple things. I can sell 3 calls that are have a strike price of 325, right? The advantage of doing that is obviously a 325 strike is gonna, get paid a higher premium. You're gonna have a higher premium than, let's say, 350, right? So I'm gonna make a little bit more money. Now, that said, you do want to be conscious and probably not trigger a wash sale. I'm not gonna get too much in the weeds, but basically a wash sale happens when you sell a stock for less than what you paid for it, and then you rebuy that stock in a 30-day period. So the IRS says that you cannot take a tax advantage of taking a recognized loss on a stock and then buy that same stock within a certain period of time. So I have other videos on wash sales. So typically, me personally, in my scenario that I just gave, I wouldn't sell 3 covered calls at that average price. If I have 300 shares, I would sell one call at whatever the basis is of 100 shares, let's say 300, and I would sell another call with a strike price of, let's say, 325, because I have a basis of 325 for another 100 shares, etc. So that's kind of how I do that. But again, everybody's got their own, way about that. The important point that you want to recognize is, number one, only sell a put on a stock with a strike price that you're okay buying at that particular price. And number two, as that price comes down, think of it as a gift. It's affording you an opportunity to buy more shares of that good stock at a cheaper price. It's kind of like, man, I go to the mall and I, see some clothes I want to buy and they're all full price and, they're nice. And I spend, $500 on some clothes. And then next week, those same clothes are on sale and maybe in some different colors. And I want to go back to the mall and I want to buy those same cool clothes and not pay full price. I want to pay a cheaper price, so, only in stocks do people get freaked out, when stuff goes down and it's cheaper. You just have to rewire your brain and not really care about unrealized loss. You only want to care about realized loss, realized gain. Also, another thing that I do, Will, who asked this question yesterday about how you maintain your composure and your thought process as prices of a stock go down, is you sell puts. So yesterday, for example, Tesla, I trade Tesla a lot as an example, but it works for any stock really. As the stock kind of goes like this, as it comes down, let's say, and I already have shares here, and as the price is coming down, I can sell a put. Like yesterday, I think it was yesterday that I sold a 310 put on Tesla for $319. So here's the thing. I take in $319. I'm going to buy another 100 shares at 310. If by Friday the price stays below 310, well, that's good, because I have 100 shares at 350, 100 shares at 325, 100 shares at 300. I can buy another 100 shares at 310. So as long as you're capitalized adequately to buy more shares at a cheaper price, it's a good thing. Also, Will had asked how, I think his question was, what's the longest period you've held onto a stock that you got assigned before it recovered? Do you have any examples? So, I've been trading for 30 years, so I have lots and lots and lots of trades. Typically, I go through periods where I trade really the same underlyings over and over and over again. And I've had trades specifically recently, actually, where MicroStrategy, I'll give you an example, that came down a lot, maybe 6 months ago or so, and I ended up selling some shares only because I was really over leveraged a little bit and undercapitalized and was had a margin call and forced liquidation, in which I had to sell some shares and bring my capital back to a certain amount, which was not ideal, because a short time after that, MicroStrategy popped up. So the only reason I did that is because I was forced to do that. Other than that, how long does it take to, overcome that? It doesn't even matter. Here's what I care about. A few months, I guess, in answer to the question. But I don't focus on that. So I don't really have a clear answer to that specific question. I focus on realized gains. I pay attention to how much money am I making this week? And realized gains, cash in my pocket. How much money did I make last week? How much money did I make the week before? That's what I focus on. Now, that said, I do try to keep my account value around the same price, because really, I don't know if perhaps, an emergency came up, I had to access, or if I were to have to access a chunk of that money. I do sort of structure my trades to minimize as much volatility as possible. So I want to make as much premium with the lowest amount of risk. But that said, I don't really care that much about unrealized loss. I care about how much money I'm taking in my pocket. So anyway, I hope that answers your question. I hope that helps. Don't sell a put on something that you're not okay buying with at that particular strike price. Try to have more capital to infuse if the market goes down. You know, somebody, I forget who it was, somebody really smart, not long ago said, you know, when the market goes up, everybody makes money. You know, when the tide rises, all boats rise. But when the market goes down, if you're structured correctly, that's when you can make a lot more money, right? So you want to keep cash on the sidelines rather, to be able to infuse into the market, you know, if and when the market comes down significantly, and be okay with averaging down your price. Yeah, so hope that helps. Tell me if you like this video. Subscribe to my channel. I'm committed to doing a video each and every day. And then send me, you can put a comment on YouTube here, or you can send me a message, not a direct message. I don't really do any private messaging, but you can send a message on Discord. I have a Discord community in which, for example, Will had posted this question yesterday and somebody else posted a question the other day. And then I can make a video about the question that you're asking. Anyway, I hope this helps. Happy trading.